Greetings, ladies and gentlemen. It's your boy XAUKING, and I'm back with another video. And in this video, I would like to introduce you to a new XAUUSD or gold pre-market open analysis. This time around, I'll start by using Pepperstone as the broker for the analysis. But before I continue, I would like to say the following. Please do not forget to like and subscribe to the channel. If you wish to trade live with me on a daily basis, do not forget to click on the links that I'm going to leave in the description, specifically the brokerage link that I use, or the broker that I use to trade with. I'm going to leave the link in the description. I'm also going to leave my respective Telegram and Instagram pages so that if you'd like to get in touch with me and trade with me in 2026, as it's going to be a year full of profits, do not forget to like and subscribe. All right, let's get to work. Well, we are going to continue by selecting our broker, like I said, and today's choice was decided between Vantage International, which is a commodity CFD broker, and Pepperstone, which is also a commodity and CFD broker. You can see by looking at the logo. Remember that we have various options to trade with or to analyze with, but the best choice is always the one that you are comfortable with because of the liquidity provider that they use. And price will vary significantly on some brokers. So choosing your broker for analysis wisely will also determine your results. In most cases, I use Forex.com, I use Vantage, and I also use Saxo Bank. All right. Owanda also provides very good charts, so I'd like to use those for a start. In 2026, I've decided to open a website officially, which is going to be called Forex University. This is where all traders seeking to make profits in 2026 by trading with me will have to sign up and get enrolled. All right. So here we started by removing our messy charts or setups of 2025. As we're moving into a new year, we need to start fresh. All right. I'm actually narrating this because I lost the audio capture for this video. So try to bear with me as I narrate the video. Now, initially, all the analysis that we do start on a daily time frames, especially for the IPD strategy. IPD stands for immediate price delivery action. So these are levels in the market or in the chart where we spot long-term setups, all right? Mostly intraday swing trades or position trades. So we're going to switch to the daily time frame in order to officially conduct this technical analysis. Forgive me if at times I'm going to fail at English, as I'm a bilingual, but I'll try my best to be as clear as possible. So moving on the daily time frame, we will officially start by analyzing our previous daily candle for a start. But in this case, because Friday's candle was the last candle that we traded on the daily time frame, we are going to analyze Thursday's candle and Friday's candle. So to analyze Thursday's candle, I am going to start by marking out the low and high of the day. Okay, we can clearly see that on the daily time frame we are bullish overall. All right, we can see that we are bullish overall, and that all the moves that you see selling is just corrective moves. And also, if you see that it takes a very long time for price to create a bullish structure, but it takes price a very short time to sell. Why? Because we call this Impulsive and corrective moves. Impulsive moves sometimes take a very long time to be formed. Okay, and this is what you can see on the daily time frame for this long. That's why we call trending. So when price is trending, it creates very long ascending moves upwards, step by step. It's like stacking. But when price is correcting, it's aggressive. Hence, people say that on a bullish trend, whenever price will tend to sell, it's going to sell more aggressively. So as you can see, it took about 4 to 5 days for price to have the previous recent build up, but it only took 1 day for price to correct, which was on a Monday. So you can see that, right? You can see that price took a very long time to build up, but when it came to correct, it just did that in a short time. Why? Because the selling pressure on that specific day was high. All right. So when price was going up, creating the structure, it moved slowly. But when price came to correct or discount, it did that in a short period of time due to the high volume. Now, I'm obviously not going to remember everything that I said as I was recording the video, which I just thought that it was recording, but it wasn't. For some reason, I got that one wrong. But let me see if I can narrate this properly. So I started off by marking out Thursday's high, obviously, which is going to be my Thursday's high. I'm going to write TH for Thursday high. And then for Thursday's low, I'm going to write TL, sorry. All right. TH, Thursday's high. TL, Thursday's low. And then we move on to the next step. This is a very important step. We're going to mark out Friday's candle. Remember that we have entered the weekend. Now we are trying to trade on Monday, but we are preparing the trades for Monday by marking out Friday's high as well, which is going to be FH. And then we're also going to mark Friday's low, which is going to be FL. Okay. After successfully defining these levels, now we start looking for sell side and buy side liquidities levels. Okay, to mark these levels, in order to mark the sell side and buy side liquidity of these levels, we need to see the bigger picture. Hence, we are zooming in and out on the chart to accurately spot these levels. Now, we understand that the all-time high becomes our buy-side liquidity, as it's where all buyers are aiming to take their profits. Okay, this is clear and easy and simple to spot. So it's an all-time high and also becomes a target, so it becomes a buy-side liquidity. Remember that the TL, Thursday's candle, apart from being TL, it's also our sell-side liquidity internally. So it's an internal liquidity. Internal sell side liquidity is Thursday's low, and Friday's high becomes internal, buy side liquidity. Forgive me for that. So we can see that the selling pressure for the all-time highs candle, basically the candle that initially gave the drop, was institutional. We don't have a wick on that candle, which means that we had no presence of buyers on that candle the moment it started selling until the moment it closed. This is how strong that bearish candle was. That's how strong bearish pressure was. And you can see also that by the small wick below there, the buyers who entered were afraid. Okay, they entered, took their profits, and the candle closed. And then on the next candle, they gained momentum and bought until almost halfway of the candle's move, and they all closed out. Hence, we have a very small body and a very large wick to the upside of that candle that comes up after the candle that gave that drop to discount. Now, this is really, but really, really, really important. Okay, I'm going to divide this video into sections or parts so that it doesn't become too long. Okay, it's going to have a part 2. All right, so stay tuned, watch and learn. So from what you can tell, I'm actually marking out the Morobuzu candles, which are these candles that don't have wicks either at the top or at the bottom. And when this happens, it means that price will eventually get back to those levels and then capture the liquidity on those areas. And we have the same thing or the same occurrence at the all-time high, which is now our buy side liquidity. So as you can tell from the other candles, they all have wicks at the bottom, but those 3 candles that I've just marked out there, they don't have wicks either at the top or at the bottom. The bullish ones don't have wicks at the bottom, and the bearish one doesn't have a wick at the top, which indicates very strong bullish presence for the candles that I'm marking out now. And for the long big sell candle, it indicates very strong sell presence. Now here I'm marking out a liquidity level that was recently just liquidated by this candle that I'm actually illustrating or showing. And you can tell that Thursday's low now becomes our internal liquidity level and also creates another liquidity level by being at an equal low with a previous order block candle. So that becomes a very important low to look at. Okay, and also because of the rejections that we have on Thursday's candle, on Wednesday's candle, and on Friday's candles, we have to be very cautious as to when the market opens for us to plot our trades, because if price opens strong bearish, then we will clearly see a liquidation of the equal low and of Thursday's sell side liquidity before price moves up. Now the reason why I'm marking out this level just right now is because I'm looking to mark out the sell side liquidity, which in reality was our monthly low, and you can tell that it was our monthly low by counting the candles. That's candle number 1. Okay, so Monday's candle is number 1, 8 of, and then we keep going up. So basically we have about 3 weeks, okay, excluding the 25th of December and the 1st of the month, which is 31st to the 1st, which were holidays. So excluding the holidays, we have a month. So that sell side liquidity that I just plotted there now becomes our monthly low, and the all-time high in reality becomes our monthly high. Okay, now bearing that in mind, we need to understand the concept behind premium and discount. We need to understand the concept behind price moving up or creating a structure before distributing. So bear with me as I use the rectangle tool, which in reality I wanted to use was the Gann box tool, which will then act as my 50% of the Fibonacci retracement or 50% of the move for premium and discount. That will help me to visualize the monthly 50%, so that when price gives the discount, then I know that if it's below 50%, price will not have to discount anymore. All right, I am patiently giving you guys this information because I believe that if you apply the same strategy that I am applying here, you could have significant profits from trading. And what I've just analyzed is that every single day, price or the market reacts in the same manner. All right. So basically, at the beginning of the day, price will begin to create structure, and at the second part of the day, price will look to break or discount 50% of the structure that it create. So if during London price begins to build structure, just know that during New York it will try to break those structure levels. Now, as you can see, I'm going to use my GAN box to mark out 50%, and I'll do this by marking out the HTH or SSL and HGH, which becomes our buy side liquidity and sell side liquidity. And once I have 50% of that, all right, once I have 50% of that, then I know that if price already passed below 50% of the gun box, which then becomes our 50% of the Fibonacci retracement, price does not have to give discount anymore. Hence, I am showing you here that 50% is already there. I just have to add 60% for illustration purposes, and you will understand the concept behind my analysis. Stay tuned, keep watching as we move forward. Now I've added 60%. I just have to flip this so that I know that 60% is right below 60%. Okay, and by confirming, I will then be able to continue with my analysis. Okay, I was just trying a few combinations to see if price was going to be exactly where I wanted it to be, as 0.62% was a bit too big for me. Now I just did an inverse move. Okay, I just reversed the move so that you guys are then able to see what I am trying to show you. All right, just keep watching. So yes, 62% of the Fibonacci is a really important level. Okay, as it becomes then our POI zone. Every time price reaches the 62% of the Fibo, or 60% of the Fibo, or 70% of the Fibonacci, we can clearly start looking for price to close. We wait for a close of the 1 hour candle. We wait for the close of the candle that we are looking to buy from, and we keep on trading. Now we have to analyze the area where price reacted. It's exactly at 60 to 70% of the Fibonacci in this case. My battery is low, but we can keep analyzing as nothing will stop us at this point. And as you can see, this correction is actually happening between the monthly low and the monthly high. And what do? You can expect to see this happening every single time. It's a behavior that the market has recently showed us every single time. So beginning of the day, price will build structure, and at the end of the day, price will want to destroy or take liquidity of that specific structure. This is a behavior that we need to look out for. So let's get this going. Okay, now let's continue with the analysis by removing the excess drawings on the chart and making it a bit more clearer. Okay, so I've decided to grab my Fibonacci retracement tool to show you guys where our POI is going to be. And every time price reacts anywhere between 62 to 71% of the Fibonacci, these are the zones that we are looking to trade from. All right. Okay. So just to quickly recap, every time you start a trade during the London session or Asia session, price will start building up, right? During the Asia session, London session, New York session will come and liquidate 50% of that move. Remember this. This is for those who are day traders. For those who are trading on the weekly time frame, after 5 trading days, on the 5th day or the last day of the week, gold or any other pair will try to discount for 50% of the move that it created. The secret is just that you have to find the direction of the market, or you need to identify the trend before using this logic. And then you can also apply the same on the monthly time frame so that you know that at the end of each month, price will look to discount. Okay, this behavior is something that I'm studying and is something that I came up with, and we are going to apply it to all our studies from now on. Okay, we have identified our point of control, which is, our point of interest, sorry. I've also added my volume profile indicator just to see how the volume was. But initially on the daily time frame, obviously because of our zones, we didn't have good study of the volume. But as we move down below on the time frames, we then begin to analyze and understand that price seems to be creating a bearish continuation structure, and the bullish or buy execution zone seems to be at 4208. This seems to be the level that we will be trading from now on. Okay, the blue line represents our point of control, and the red lines it represents the level with high volume nodes. And this level with high volume nodes is a level where most orders have been placed. Now, these orders can either be pending orders, okay, sell limit, buy stop, sell stop orders by institutions, or it can be a zone where many stop loss orders are set, okay. So you have two options. You can either execute your trades at the point of control, which is the 4258 zone, which in my opinion would be a very good zone to buy from, or you can expect price to reach exactly where we call the high volume node area, which is at the 4208 level. And once price reaches 4208, that's where we will be looking to execute the orders from. Now we have a high volume node or area also, which was there at 4332 before I removed the volume profile indicator. Let me get back to you in the next video. Okay, so in continuation, we clearly have already spotted our point of interest. Okay, this point of interest is both a point of interest for buy movements or sell movements. What do I mean by this? Well, in case price happens to break below the sell side liquidity, we could be grabbing the secondary sell side liquidity. So initially our secondary sell side liquidity lies at the external level, and the internal level is the one that I'm marking the Fibonacci retracement tool from. So anywhere between 62% and 71% of the Fibonacci, these are levels that I've tested and it always almost works. Okay, price will react and move in the opposite direction after the pullback. Okay, so like I said, sell side liquidity number one is the external one. Sell side liquidity number two is Thursday's low, is internal. And then we have the Friday's high, which is also an internal. Okay, these zones are really important for us to look at. Now, we could be looking to make anywhere from 1 to 50 to 1 to 116 risk and reward ratio. Okay, this level, okay, This level here is our entry zone. Okay, these are entry zones, and I'm going to remove my Fibonacci retracement tool levels because I don't want people to copy. But anyways, if you do copy and you understand how to use them, it's going to work for you. If you don't and you need help, just contact me so that I can help you. The bullish candle that just opened on Friday before market closure clearly shows us that there's strong bullish momentum. This is why the candle has no wick at the bottom. Now, these candles can be grabbed, okay? Liquidity of these levels can actually be grabbed at any time. But based on historical data, each time these candles appear on a higher time frame, it could simply indicate that price is very strong and price could be moving in that direction soon. And the best way to trade is actually to follow behind price and not against it. Like most people say, it is easier for you to follow the market than for you to catch a falling knife. So why would you open a trade in the opposite direction when the market is actually uh, selling, for example? If the market is selling, isn't it easier for you to sell as well? Would you rather buy when it's selling strong, or would you rather sell when it's selling strong? Okay, let's keep those things in mind. The other thing I have in mind is also at that specific level, we have a fair value gap and I have an entry level there. So I expect price to do something funny, all right? Or react at that specific level to a sell position before moving back up. But it is just a possibility, it's just a probability. We have to consider that we are on a bullish trend overall on the daily time frame. So selling at any given selling opportunity just because the market presents it like so doesn't mean we're going to get good results. All right, yes, initially after this corrective move we are on a sell situation, and this is on the daily time frame. Before we break Friday's high, we are still on downtrend territory because Friday's high and the previous high before Friday's high clearly indicates that we are in downtrend territory for now on the 4-hour structure. But on the daily structure, we are on a higher time frame. So now we have to see which will price respect. Will it be the 4-hour or the daily time frame? Both are higher time frames, but which one, in your opinion, will price react to first? Okay, this is a very important question and you can answer it for yourself. Now, I'm going to project the trade by placing my stop loss at that level and my take profit target on the first level. That initially will give us a 1 to 10. If you're a chicken, you can close your trade out at 1 to 10. But if you're a man and a trader, a strong trader, you can hold all the way up to 1 to 20. And if you're a superhero like me, you can hold this trade all the way to 4,800, as it was the projected take profit level before the year ended. But logically speaking, closing your trades at a 1 to 10 risk and reward ratio, which is the first take profit target that lies right around the all-time high, is the better choice to make. But like I said, if you're a superhero and you want to make more money, you want to test yourself, redeem yourself, take this trade to $5,000, right? When gold hits $5,000, that's when you close your trade. But obviously, as soon as the market opens, we have to watch out for the market structure, for the formation of any bullish or bearish patterns, as it will give us the signal to enter at the right place. Entering at the wrong place could result in excessive losses, as this is a very bad first half of the year to trade. Now, initially, price is showing me an inverted heads and shoulder on the 15-minute, which could be good, could be a signal for buy continuations. But before we break the Friday's high, I am not going to be hyped about the long move until I'm above that. So for as long as I'm below that, I'm taking a very big risk. But for as long as I'm above that, yes, I'm just trying to be somebody who understands the market. Now, as a professional, I will most likely always use my Fibonacci retracement tool to know exactly where I want price to be before I enter my position. And at this moment, I want price to come back to that level so that I can then plot my risk and reward ratio tool. Remember that I'm always looking for the best rewards as possible. I mean, if you enter with a big lot size there where price is at, you should definitely be able to make sufficient money for yourself. I mean, in any given strategy, you could be making anywhere from 1 to 10, 1 to 20, 1 to 50, to 1 to 116 risk and reward ratio. Why on earth wouldn't you want to be a part of this trade? So I initially spotted a fair value gap at that area. And the first thing I would like to see is price to get back to that fair value gap, and then I can take the short. If price doesn't get back from that fair value gap, I'll just take the short exactly where it is and increase my stop loss. That will result in me reducing my lot size, because then I would have to hold very big drawdown in case price comes down. So it's a risk, okay? If you don't take risks, it's a bad thing. But if you take calculated risk, you're a smart guy. So let's calculate the risk properly before we enter. That initially is going to be the level where I will be looking to execute my trades if it gets there. If it doesn't get there, then I should be looking to execute my trades, like I said, at 4332, and stop losses should be anywhere above 4332 and below 4321. So let's go. The risk and reward ratio would be increasing because every time you plot your trades on a lower time frame, you get the best risk and reward possible. All right, don't forget this. Don't forget this. 1 to 54 to the all-time high, and 4800 you have 1 to 116. That is amazing, guys. That is just amazing. So I hope you like and subscribe to my channel. I hope you stay tuned because I came back with a bang. Okay, now we are seriously trading with the best risk and reward ever. I remember times when I was learning how to trade Forex, and I wouldn't believe when I saw people talking about 1 to 100 risk and reward ratio. But today it is possible, and I'm actually doing it. Okay, I'll soon be posting videos about my journey of trading with a big capital or with a big account. I'll be documenting it, and I hope you guys enjoy. As I'm enjoying, I hope you enjoy. So this is it from my side. See you guys in the next video.